Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Ophelia Snyder, co-founder and president of 21Shares, the world's largest issuer of crypto ETPs. We're talking about spot Bitcoin ETF and the recent filings which have generated so much buzz lately. So Tyler and Cameron Winklevoss first filed for a spot Bitcoin ETF more than 10 years ago when the cryptocurrency was trading under $100. And since then, the SEC has rejected more than 30 spot Bitcoin applications. But there is speculation that the agency may finally give its blessings to one now. And 21Shares, in fact, has a live spot Bitcoin ETF application in partnership with Cathie Wood's ARK Invest. So Ophelia is the perfect guest for this topic. Ophelia, welcome. Great to have you on the show.
Thank you so much for having me.
So you are joining us for the first time on this podcast. So we'd like to know a little bit about you and 21Shares.
Yeah, so I started this company about 5 years ago. We're actually celebrating our 5-year anniversary in November with an old friend of mine to solve a super simple problem. At the time, this is a bit of an unconventional story, actually. So one of the first people to ever talk to me about crypto was my mom. She came to me in about 2013, and she was like, I was reading about this super cool thing. It's called Bitcoin. I think it makes a ton of sense to have a global currency to facilitate international trade, reduce hedge costs for multinational companies, and allow us to more efficiently globalize supply chain and trade routes. And I was like, excuse me? What are you talking about? And she loved the concept, completely got the thesis behind it, digital assets, means of exchange, global reserve currency, alternatives to gold, historical context, got the whole thing, but she never really felt comfortable allocating because fundamentally for her, it represented the need to open a new bank account. And she didn't really want to have to open new accounts and all this new infrastructure just to make a single investment. And there weren't really any investment grade products that were available to her. And my co-founder's mom, who is a phenomenally intelligent Egyptian woman, had a very similar set of issues. And so we got together a few years ago and started talking about, our moms really wanting to get into this space and not being able to, and the fact that they needed a product that would be suitable for them. And we started exploring and figuring out different product structures and different alternatives and what could be done in the sector before eventually landing on launching a crypto ETP in Switzerland as the best way to provide this type of exposure in sort of the safest, most transparent, most simply structured kind of way. And so that's what we set out to do. And learned quite a bit about ETFs along the way, but the goal was always to provide safe, reliable, regulated access to this industry in a way that would welcome more people into the community.
Very interesting. So now let's talk about Bitcoin a little bit first before we discuss these ETF filings. So Bitcoin has rebounded over 80% this year, though it is still down more than 55% from its 2021 peak. And many investors lost a lot of money when cryptocurrencies plunged. And then there was the series of bankruptcies too at major crypto companies, including FTX. So it was a brutal crypto winter for crypto investors. So tell us, what is behind the rebound this year?
So I think there's a couple of things. I think it's important to both look at sort of what drove that market correction as well as sort of what's driven the rebound, because I think my perspective is that in large part the market overcorrected tremendously when sort of during the course of the bear market, right? The sort of lows that we saw were driven by like a series of black swan events, including like a very large instance of outright fraud in the context of FTX, right? FTX has actually nothing to do with crypto. FTX is just fraud in very plain vanilla TradFi kind of ways. It's not particularly interesting. It's essentially a Ponzi scheme. And I think we had a couple of these events happen together. You coupled that with a market whose sentiment was shifting away from revenue-based valuations for tech companies towards having a much stronger focus on profitability. You saw tech as a whole get absolutely hammered. Within that, VC-backed companies did worse. So the higher profile companies, essentially, if you look at VC funding rates, completely locked up. Within that realm, both public and private, within tech, fintech actually did worse than tech at large. And, a subsegment of that that's even potentially higher risk is where crypto sits. So you're dealing with a macro backdrop that was extremely negative on these types of assets, coupled with a couple of black swan events that are, one of which was actually crypto related, but a couple of which are just people doing fraudulent activities and people doing poor risk management in centralized counterparties. Three Arrows Capital is an instance of fraud. So was FTX. And so I think to some extent, the market, quite understandably, reacted very, very, very strongly in sort of the back half of last year. And so a lot of the lows that we saw were likely over-exaggerated. I think a lot of what we're seeing now is a bringing of pricing back to a place that actually makes sense with respect to what you're seeing in terms of on-chain activity and what you're seeing in terms of institutional adoption and who's actually active in this space, not just in the context of Bitcoin, but actually in the context of the entire, digital asset ecosystem. We're seeing major developments in crypto, in everything from Bitcoin and NFTs and smart contracts on Bitcoin networks to the movements around Ethereum and the evolution of proof of stake on Ethereum networks and sort of some major technological leaps forward in smart contracts. Pricing now feels more in line with actually where the industry is. And that's great. Pricing is usually a lagging indicator in crypto of the actual development that's going on. So we're likely looking at the last year worth of bear market development that hasn't even really hit public markets in terms of visibility yet. So I think it's going to be a very interesting couple of months from that perspective.
Right. So that brings us to these ETF filings because Bitcoin has risen about 20% since BlackRock filed for a spot ETF application. And then many other issuers also quickly joined the race with their own filings or resubmissions. And in fact, your ETF application is first in line. And then there's this decision expected on this lawsuit filed by Grayscale against the SEC over conversion of GBTC into an ETF, which is expected this fall. So tell us why now, and also tell us about your ETF application.
So a lot of things have changed. The crypto market has been steadily maturing for years. And so, every time we look at these applications, and we've had applications active for, most of the last 2.5 years, basically, you can see it in the data that the market is changing and the market conditions are actually materially different infrastructurally than they were a couple of years ago. So there's one element, which is just this continued sustained progress that's been happening in the space. The second is these surveillance sharing agreements. And I think there's been a lot of confusion about what these actually are. They are, candidly, the least interesting thing possible. They're not live data feeds that are providing tons of information. They're not, these massive integration efforts. They're actually really wonky, really technical back-end infrastructure that exchanges have, primarily with each other. That is actually very little to do with issuer-side regulation. It actually has nothing to do with issuer-side regulation in the United States. But what it does is it allows crypto markets to exist within the existing surveillance framework for financial markets in the US. We're specifically related to market manipulation. So all this really allows is under very specific circumstances, you're able to collaborate with a counterparty to investigate potential market manipulation across different markets. It's not particularly different than what exchanges are already doing. It just allows them to do that in a more collaborative way and form part of this sort of standard infrastructure for the United States. And if you notice, I think I said the word standard a bunch of times in there, and it does. It brings crypto markets more in line. So it is a material difference from that perspective. And I think that's a lot of what people have been so excited about, specifically with the filings that have come out in the last few weeks.
So thank you for talking about surveillance sharing agreements and explaining in simple language. Because in the past, the SEC has cited concerns about fraud and manipulation and the need for this comprehensive surveillance sharing agreement with a regulated market of significant size. And to many experts, these concerns did not make much sense because they have approved many futures-based products, and recently they even approved a leveraged futures-based Bitcoin ETF. So I was interested in your thoughts on SEC's prior concerns regarding fraud and manipulations.
If you look at the data around these exchanges, and I think a lot of it is, you're looking at wash trading, you're looking at sort of price discovery and sort of which exchanges are leading versus lagging in price discovery. That's typically what people worry about in the context of manipulation, right? And so as the market's gotten bigger and deeper and more liquid, those types of practices are actually much more difficult, structurally more difficult. It's a lot harder to change the price of an asset with, if there's $10 of trading volume a day, that's going to be really easy. If there's $100 billion of trading volume a day, that's going to be really hard, right? How much do you have to do to actually do this? So on one hand, the actual growth in the market makes a lot of these practices candidly, just less likely. The other thing, if you look at the data, that's also evolved over the years, and you're seeing far less support at a data level for those kinds of claims around sort of what the state of the market is, especially in the large established markets in this sector. Coinbase being an excellent example of that. They have their own mechanisms in place to actually protect against markets manipulation, and the data seems to suggest that that's going well. And so I think it's very difficult to say, concretely, yes, we can prove that crypto markets are manipulated. That's not really the state of current market conditions.
So do you think the latest batch of applications, including yours, which include these surveillance sharing agreements, they will now address SEC's prior concerns?
I think it's an important step forward. We have relationships with regulators all over the world. It is a big part of what we as a company, need to course of our business. And one of the things that we've seen is that people are getting increasingly comfortable. There are better and better answers to these questions. So I think this does move the ball forward, and it hopefully starts to change the conversation and progress it to other more nuanced points around this market. I think it's difficult to say. Obviously we're bullish on it and we're excited to engage in this conversation. I think it's really difficult to say right now until there's been more feedback from the SEC after these types of agreements have been put in and after we sort of understand where the judiciary sits in terms of grayscale, to really know exactly where all of this is going to shake out.
That makes sense. And now I was also interested in your thoughts on why this is such a big deal, because there are many futures-based products available to investors, and there are many crypto ETPs which are trading in Europe and in Canada, which some of the US investors can access. And there are many other ways of investing in cryptocurrencies directly as well. So why is a spot Bitcoin ETF such a big deal? Do you think it will be a true game changer?
So, if you look at the European market, and we run 37 different products in Europe. So we certainly go well beyond just Bitcoin exposure. And you look at why our customers buy it. And I think that's actually, it will tell you a lot about what you can expect in the US market, I think. These structures provide a couple of things. They provide you access to custodial services that you otherwise would never have access to. And even most institutions don't have enough assets in crypto to get access. And what that means is it's enhanced security, better insurance policies, better sort of overall practices around how we're safeguarding your assets, more separation in terms of like being bankruptcy remote and having sort of that clear assignment of assets versus what a retail investor could expect to get from an exchange, or even a mid-sized institution could expect to get from a custodian. And that comes just quite frankly with scale and with the fact that you're actually dealing with experts in this field. So there's that element to it. There's typically some tax clarity, this is especially important in Europe. So it tells you exactly how it's going to be treated from a tax perspective. And quite frankly, you get the experience of a firm that has been doing this for a long time. And crypto assets have some unique properties, things like forks and airdrops and certain interactions that happen in an on-chain environment that are a little bit different. And so the trading runs a little bit differently. The custody runs a little bit differently. That reality means that the expertise of having somebody else manage that for you is actually quite valuable. It falls under the category of, you don't ask a grain trader where their grain silo is because it's actually not relevant, even when they're, dealing with physically delivered futures. The reason for that is that it's actually just infrastructurally quite different. And so this is a convenient packaged way to get access to this product suite in a way that's going to be liquid and transparent and compliant, and you don't have to build all of that out. And so I think this really does enable a certain group of investors to enter the space for the first time, especially those that have fund mandates that, for example, maybe don't let them buy crypto directly, but certainly would let them trade ETFs. Those types of things can actually be very helpful from a structural perspective.
All good points, very important points. And I agree with you. The findings and the possibility of an approval has captured so much attention because investors are actually waiting for a spot Bitcoin ETF, many retail as well as institutional investors because of the mandates which you mentioned. And they just love the ETF wrapper. So if a spot Bitcoin ETF is approved, this could be one of the biggest ETF launches ever, if not the biggest. And Bloomberg analysts pointed out that crypto ETPs account for about 1% of all Canadian ETF assets, and applying the same logic to crypto ETFs in the US, that would equate to an asset potential of about $54 billion. So it's going to be a massive launch. So now talking about these filings and the timeline, the latest batch of applications have all been published in the register by the SEC. So there's a certain timeline now. The clock has started. And I have heard some experts talking about the possibility of the agency approving all on the same day, because we know that the first mover's advantage is huge in the ETF world. Better, the first US listed futures-based ETF gathered over $1 billion in just 2 days. And those that entered the space just about a couple of days later, they have struggled to gather assets. So do you think the SEC could approve all ETF applications on the same day? And could you also talk a little bit about the timeline when you expect to hear from the SEC?
Sure. So a couple of things. Yes, you're right about first mover advantages in this space. I think there's a lot of precedent around these things. So, people have asked me a lot, do you think they will change the order and respond to somebody else first? Like, I don't think those kinds of things are realistic, just purely on the basis of it would undo years of precedent that the SEC has worked quite hard to establish. I think the question around, could they all be approved on the same day? I mean, theoretically, yes. They have occasionally done things like that. It's not super common, but it's possible. I think the more interesting thing is going to be, what do people bring to the table in bringing these products, right? At the end of the day, yes, you're right. A couple of days definitely does matter in this context, but also for being, honest about it, there's also a question of like, what do each of these issuers actually provide, right? What expertise are they bringing to the table? How are they approaching their client base? Like even if you look in Europe, the client bases between different issuers are actually very different. And therefore the products behave quite differently under, times of stress or, are they long-term holders? Are they hedge funds? Are they actively trading? Are they, buy and hold? These are real questions. And I think it's going to be quite interesting to see what happens post-approval for these products. Because I think it's possible you end up with someone going first. And obviously, that would likely be us because changing that order would be different. I think it's possible they all get approved at the same time. I think the question will really be, on a longer term basis, what is each issuer actually bringing to the table? Why are you picking that product? Why are distributors adding product to platforms? And I think that's going to be the most interesting piece.
Right. It's going to be very, very interesting. So I just read this week that Europe's first Bitcoin ETF is set to launch later this month, and that comes after a year-long delay. And so far, all crypto assets in Europe are structured as ETNs, exchange-traded notes, rather than funds. So could you talk a little bit what that means for investors, and are you also planning to launch ETFs, because your products are also exchange traded notes currently, right?
Yes. So there's a couple of pieces to this. And the European market is a bit different than the American one in this context. So you need a little bit more context to understand sort of the relevancy here. In Europe, ETPs are a very standard structure for exchange traded products, especially when it comes to something called a non-UCITS product. So UCITS is what most people would consider in the US to be a regular ETF. It's a fund structure. It has all of the distribution benefits. It's got the liquidity benefits. It's really like the main way in which ETFs are created in Europe. Now, crypto is not currently a sort of allowed underlying for a UCITS product. And also single assets don't meet the diversification of UCITS. So you can't have a UCITS ETF for gold bars. It doesn't actually work that way. So what you're dealing with here is a non-UCITS product. There's some overlap with how the ETPs work and obviously with the products that are proposed in the US, but there are also like a few key differences here. Features that exist in both are sort of the daily trading, creation, redemption mechanisms, trading at NAV, third-party custody. But unlike ETPs and these proposed structures in the US, which can trade in increments as small as $10 or less and are easily accessible to retail, the new product that's being rolled out, my understanding is it's not going to be available to any retail purchasers. It has a required minimum investment of $100,000. And obviously, that's very anomalous for an exchange-traded product, really in any market. And so, from our perspective, we've gotten this question: does this open up other issuers? What's that going to look like? And quite frankly, because the market understands and can evaluate the ETP structure, and because it's such a standard way to approach both sort of single asset commodities as well as, quite frankly, more generally, more exotic underlyings. It provides transparency and an institutional grade product that can be accessible to retail. This is all certainly true of a UCITS ETF, which are harmonized in the European market, but that's not really the case for what we're seeing with this new product come out. And so any conversion from our perspective would make it materially more difficult to serve our customers with these best-in-class, accessible, institutional grade product. It just wouldn't really fit our customer base.
So switching gears a little bit, I wanted to talk about the investment case for Bitcoin and other cryptocurrencies. So people talk about Bitcoin being digital gold, inflation hedge, or providing diversification benefits. Also, it's limited supply, and there are skeptics who call it a fraud or a Ponzi scheme. What is the best investment case for Bitcoin in your view?
I think there is a real case for a more globalized monetary system. I think as we're looking at a world that is less geopolitically harmonized, the ability to send and move money globally is going to be something we have taken for granted in the last 20 years. And so a decentralized neutral system is quite helpful. And you sort of saw that with people being able to actually, get money into Ukraine in the form of aid quite efficiently at the start of the war using crypto. So I think one element is actually monetary system and payments. I think another element is actual reserve currencies. The level of dominance of the US dollar as a reserve currency is actually a historical anomaly that's largely existed for the last 50 years. That's not necessarily like a status quo kind of thing. In the 50s, you didn't have 80+% of global reserves denominated in US dollars. And so I think there will be room for some diversification there. And I think crypto assets and Bitcoin in particular can play a really interesting role in providing sort of a neutral standard for those reserves and for certain types of transactions. I also think you're seeing sort of a new wave of adoption, a new wave of use cases associated with crypto. It's essentially programmable money, which means you can have it behave a certain way based on rules. It makes it easier to do things like self-enforcing contracts. You do X, I do Y, therefore I have to pay you. And you can automate that in a really interesting way and actually reduce the need for trust in systems. And I think that's also a really powerful and impactful use case.
Excellent. We'll have to leave it there. That was a great conversation. Thank you so much for coming on the show, and hope to talk again soon.
Thank you.
That was Ophelia Snyder of 21 Shares. Thanks for listening. I hope you enjoyed the conversation. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.